I mean, the short answer is that there isn't a big impact for oil prices, and that's exactly what we've seen. As you said, oil is up only slightly today on the news. I mean, it's escalatory. It's an unprecedented attack by Israel on Qatari soil, and it is quite a geopolitical shock. But the pattern is very similar to what we've seen in the last couple of years, where there is a geopolitical event, a shock, and we do, and in some instances, get an intraday shock as the market investors try to price that higher risk of actual disruption to oil supplies. But then once the market realizes that there hasn't been any disruption to production or to any of the oil flows, those gains are paired.
In some instances, gigawatt scale data centers. And it's not just a US and European phenomena. We've got a note out today looking at the Middle East in regards to this topic. And I think some of the interesting things about that are just that we do think it supports additional solar build out in the region. I guess it's always interesting to note that it's quite sunny there, and there already is quite a bit of solar being deployed there at the moment. We also think there's good read across into the gas market as well. And I think part of the story is just simply that when you look at the US or even Europe, our countries can't, frankly, get power projects built fast enough to meet the speed with which some of the hyperscalers want to move.
We published 4 notes on Europe's nuclear renaissance, and we tried to size up what the capex opportunity would be, and that stacked up to roughly half a trillion euros. And that supports a build of roughly 70 gigawatts of nuclear, almost evenly split between large-scale reactors and the new generation of small modular reactors. So Revolution Wind is 80% complete. Most of the wind blades are already there. I recently checked the injunction, or like the lawsuit that Orsted is actually going against the Trump administration. And that lawsuit states that they stand to lose almost $7 billion if they were to exit Revolution Wind. So $7 billion is roughly 49 or 50 billion kroner. Orsted's market cap is roughly 85.
Good morning, good afternoon, everyone. This is Rob Barnett, and I'd like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. On the call today, we've got 2 regulars from the BI team. We've got Salih Ilmaz joining from his usual perch over in Dubai, and then swinging over to Madrid, we've got Patricio Alvarez joining. Let's start with a check-in on commodity markets. I'm looking at my screen right now. Brent crude's about $67 a barrel. Salih, you've got a note out this morning looking at the latest geopolitical tensions, specifically Israel's strike in Qatar targeting Hamas leadership. Would you like to break down for us kind of what you think that potentially means for the oil market and how you're generally thinking about things here at the moment?
Sure. Thanks, Rob. The short answer is that there isn't a big impact for oil prices, and that's exactly what we've seen. As you said, oil is up only slightly today on the news. I mean, it's escalatory. It's an unprecedented attack by Israel on Qatari soil. And it is quite a geopolitical shock, but the pattern is very similar to what we've seen in the last couple of years, where there is a geopolitical event, a shock, and we do, and in some instances, get an intraday shock as the market investors try to price that higher risk of actual disruption to oil supplies. But then once the market realizes that there hasn't been any disruption to production or to any of the oil flows, those gains are paired, and that's what we saw yesterday. And I mean, I would just say that that definitely has been the main driver in the last 20 hours or so. But generally, the outlook for the oil market is relatively bearish, and we've been talking about this for a while. When you look at the next couple of quarters, we got demand that's still giving us mixed signals, and we have supply that's very likely to grow at a much faster pace than the demand expectations. And on top of that, over the weekend, we had OPEC Plus saying that they will not pause their output hikes, and they will continue to hike output from October onwards. Granted, their plan for an output hike in September was about just over 500,000 barrels per day. From October onwards, it's going to be much smaller. It's going to be around 137,000 barrels per day. But the point being, they will continue to try to bring more supply into a market that's already looking very oversupplied. So beyond the geopolitics and whatever geopolitical risk premium that may be bringing into the market, which clearly is quite negligible, the general outlook for the oil market is still quite bearish when you look at the fundamentals picture. And the spot market and the physical market is still relatively tight, but when you look just beyond the next couple of months, it is looking much looser. So that's what happened over the last day or so, and over the weekend with the OPEC Plus meeting. Our note this morning, as you mentioned, is looking at all these drivers. If you haven't seen it on the terminal, feel free to take a look. And yeah, generally our view is not changing because of what's happened yesterday.
Sally, I would like you to maybe frame this in the context of some scenario work you've been doing lately. So you've made the case for how the fundamentals sort of paint a bearish near-term outlook, and you've got some scenarios pointing to $50 a barrel or even lower. You also have an upside case where you talk about $100+ barrel oil just out at the beginning of this month, and in that scenario, I know you talk about geopolitical factors being the key catalyst, but what beyond sort of the headlines that you're seeing now would need to occur to really put you in that high scenario?
Sure. I'll try to briefly outline this framework that we're trying to build for the rest of this year and for next year on oil prices. But the short answer to the last part of your question is that we think it's pretty much only a major geopolitical shock that actually impacts production or flows that could take us to $100 a barrel oil or above. So at this point, we don't think fundamentals would take us there. But just to give you an idea of how we're trying to frame these scenarios, our base case scenario is $60 to $75 a barrel. In this scenario, we see a modest surplus in the market. There is a lot of supply coming online, especially in the next 2 quarters. Demand growth is not going to be bad, but is probably not going to match it. So we see gradually moving down this $60 to $75 a barrel range in the next 12 months or so. But beyond this base case scenario, we have the looser fundamentals scenario where there's more supply than we expect in the base case scenario, and demand actually undershoots versus our expectations. And in that scenario, we see prices in the $50 to $60 a barrel range. And on the flip side, we have the tighter fundamentals that takes us above $75 a barrel. But we are assigning probabilities to these scenarios. And to your point about our view that it's more likely that we are in a looser fundamentals scenario compared to tighter, is that we assign a much higher probability that we are in the $50 a barrel room. It would be a lot less likely, according to these probabilities, that we are above $75 a barrel. And then on the tail ends, we have a severe downturn scenario where oil prices go below $50 a barrel. It's a tail end, low probability. We give it a 5% chance. And on the flip side, as you mentioned, a major geopolitical shock that takes us above $100 a barrel, we give that a 5% probability as well.
Thank you for that very helpful framing, Salih. Maybe this is just a good point to mention to everyone listening that you have orchestrated another survey that we are giving to our clients, everyone listening today, to get their read on the market. And I know you ask a number of things about OPEC in that survey and geopolitical risk factors. So do you want to just give a quick highlight of the survey? And then I think this would probably be a good point to drop the link into the chat for everyone to participate.
Yes, thank you, Rob. Thanks for reminding me. I mean, our regular readers and listeners will be familiar with this. This is a survey that we do at least once a year, usually twice a year. And I actually find it quite fun to fill it out, and it's really interesting and fun to see the results. And it generally gets very good traction with our readers and our listeners as well, because it's quite difficult at times to get a sense of the sentiment in the market, and this is generally a good way to get a good sense of what folks are thinking. I have just shared the link on the chat. I hope everybody can see it. It's very easy to fill. It shouldn't take longer than a couple of minutes. It's very smooth. You don't even need to click next. As you choose your answer, it just goes on to the next question. And I should mention that if anybody's listening on their mobile, this is mobile friendly. You can take the survey on your mobile device as well. It's anonymous, as always, and we are going to keep it live for about a week. And then once we get the results, as we always do, we will share the results on the Bloomberg terminal. And I will be back on this call to give a quick overview of the results, and I will share the results on the chat here as well once it's done.
Thanks, Salih.
Let me just make sure it went to everyone. It may not have.
We'll follow up and make sure everyone has a link, but look for it in the webinar chat, and we'll also follow up with it over email. Patricio, let's get you into the conversation. Just curious to frame some commodity outlook perspective on the gas market. I know you've written previously about some of the geopolitical risk premium feeding into European gas prices. And how would you frame what we heard from Salih just about the risk from the Middle East here at the moment?
Sure, Rob. So it does kind of follow a similar trend to Brent oil, but I would say that the impact is it's much more distant. So again, like the potential escalation of tensions in the Middle East, it could threaten global energy flows, mainly through the very unlikely event of a blockage of the Strait of Hormuz. On that front, if that were to happen, several flows or LNG flows would be blocked. But we would need to note that Europe is no longer really purchasing much LNG from Qatar. So that wouldn't directly impact European gas balances. We've been pretty much tapping out our import capacity towards the US. So all of the increase in LNG imports in Europe this year has been driven by the US. So we don't expect or don't see a direct impact from a potential escalation of tensions, unless there's like this very unlikely event in which the Strait of Hormuz is closed. But as Salih said, we think that that's highly unlikely, and otherwise the fundamentals actually look pretty bearish for European gas as well. European gas storage is trending above 80% at the moment. So it looks like we are on track to be at least 90% full by the end of October. That's pretty much in line with the European Union's target. The other two caveats are that we expect incremental LNG supply capacity to come online by the end of the year. We will see a 9% increase in LNG supply, according to our colleagues at BNEF. So that's global LNG supply is going to grow nearly 10% year over year. So it's a big increase. And the other big bearish signal is a sustained decline in LNG consumption in China. We've been seeing double-digit declines since November of last year. And unless there is a significant recovery, we think European gas prices will actually go under 30 euros per megawatt hour as we head into 2026. The situation, just one last point on the situation in the Russia-Ukraine conflict. It looks like there is not a lot of scenarios in which Europe suffers another curtailment of gas flows from Russia. The EU has been reticent into sanctioning Russian LNG. We still receive roughly 15 billion cubic meters of Russian LNG. We don't think we're going to sanction that soon. Any sort of peace deal would actually improve the chances of some of the pipeline flows via Ukraine to come back. And again, that just reinforces our view that perhaps there are more bearish signals than bullish.
Okay, thank you, Patricio. Let's switch gears a little bit. For anyone who hasn't been keeping tabs on us, and we certainly won't hold it against you if you're not reading everything we write, but we have been putting out a series of notes on the intersection of AI, data centers, and energy demand. If you somehow have missed some of the headlines on this, there is a very big bullish signal in the market for energy demand coming from data centers. All the uses of ChatGPT, Google Gemini, Anthropic on down the line, they are quite energy intensive to do these queries versus traditional Google searches, that sort of thing. And we are seeing a big proliferation of very specific power projects being built to support these very large, in some instances, gigawatt scale data centers. And it's not just a US and European phenomena. We've got a note out today looking at the Middle East in regards to this topic. And I think some of the interesting things about that are just that we do think it supports additional solar build out in the region. I guess it's always interesting to note that it's quite sunny there, and there already is quite a bit of solar being deployed there at the moment. We also think there's good read across into the gas market as well. And I think part of the story is just simply that when you look at the US or even Europe, our countries can't, frankly, get power projects built fast enough to meet the speed with which some of the hyperscalers want to move. So I encourage you to take a look at our Middle East note out today. Patricio's got one coming out tomorrow looking specifically at Spain. We've covered the Nordics, US, ERCOT on down the line, and we're happy to chat in more detail about that. But Patricio, I want to tie this topic into a note you put out just the other day on nuclear. So you've been specifically looking at how this big AI narrative feeds into what's happening with nuclear in Europe, and you've got some pretty big numbers. So break it down for us. What's going on with the future of nuclear power in Europe here at the moment?
Sure. So I'll just start by saying that we published 4 notes on Europe's nuclear renaissance, and we tried to size up what the capex opportunity would be. And that stacked up to roughly half a trillion euros. And that supports a build of roughly 70 gigawatts of nuclear, almost evenly split between large scale reactors and the new generation of small modular reactors. That is using pretty much the current cost estimates and some of the more optimistic cost estimates for SMRs. So yeah, that's a big number. It's $500 billion. But I will say that that's part of a deep dive that my colleagues in the US are also working on, so that the actual global number will be much higher than that probably. So now moving on to the speed. So obviously, yeah, there is a nuclear renaissance happening. We've seen several companies make announcements and also governments making pledges. So the UK is actually going to directly fund part of a new nuclear reactor, Sizewell C. They're going to have 50% stake, and they're going to have a regulated asset-based model. So that really shows that there is real momentum to de-risk the funding for these projects. But that said, it does face a very poor track record of construction. So large nuclear tends to be very delayed and over budget. The last reactor we built in France took nearly 17 years to build and was more than 30% over budget. So with that in mind, knowing that it takes more than a decade, and the fact that most SMRs won't be commercially available until the mid-2030s, we think that if this surge in AI power demand or data center power demand materializes in the next 6 to 8 years, which we think is really the window, given that all the tech companies will be racing to win this AI race. Sorry for the reiteration there, but it's really the pace of the demand that we're seeing that will probably not match the speed at which nuclear is being built. So on that point, we do think nuclear will have a place in the power stack and the overall sort of decarbonization of grids through 2050. But in the medium or the near to medium term, so the next 3 to 6 years, we think that gas and renewables, mainly solar and batteries, will be better placed to meet incremental demand. And we've been seeing anecdotal evidence of this already. We've been seeing companies in Spain, for example, entering JVs to develop data centers directly, to repurpose coal plants into data centers, given that they already have the grid access. So it's a mix of both hybrid models, trying to do behind the meter type of projects, and combine that with some grid capacity as well. So we think that just the speed of demand will probably outstrip the pace at which nuclear is being built.
Yeah, very interesting, Patricio. For anyone who's been following Secretary of Energy here in the US, Chris Wright, he's been out talking about nuclear quite a bit over the last few months, and he's making a very strong case for a nuclear renaissance here in the US. And I think he's particularly focused on the next generation of reactors, small modular reactors, even fusion reactors. Is some of that discussion happening over in Europe? And when you think about the potential build out over there, I know you mentioned Sizewell C, and that's a traditional reactor, but is there a lot of activity on either the SMR front, or however you want to characterize it, the sort of new types of reactors that companies are exploring? And I guess the question might be, to tie it back into AI, is do you see the potential for some of these newer technologies to actually move faster once we get them demonstrated?
Sure. So on the first question, we are definitely hearing more and more momentum around new small modular reactors here in Europe as well. So that would be mainly on Rolls-Royce. I think that there's a big story around Rolls-Royce's potential to develop SMRs. And that is pretty much a matter of trying to make a smaller version of current technologies. So that, I do think there's a good visibility there. The company has entered into a JV with ČEZ in the Czech Republic. So the Czech Republic wants to build a few gigawatts of small modular reactors, and they're co-investing with Rolls-Royce. Rolls-Royce's design in the UK has been approved or is on track to be fully approved by the end of the decade. It's already on testing phases. So there is momentum. There's also new small modular designs by EDF. So it's definitely happening. I would just say it's the part where it's different from the US is that we are not seeing, for example, the restart or the extension of nuclear plants to cater to AI demand. So, for example, the 3 Mile Island case, where a tech company is paying for the restart of a plant and they're going to consume power directly from the reactor. That is not happening in Europe. I think the story here in Europe is more about trying to modernize the current fleet, which is aging. It's on average almost 40 years old. So it's more about modernizing and sustaining current capacity rather than growing a lot into the future. Well, that said, you also have in the US, you have these policymakers that are also pledging, faster permitting or reducing that red tape, and also putting tax credits available for nuclear. So the story in the US perhaps is heating up faster or more than it is in Europe, but it's definitely also building in Europe as well.
Thank you for that, Patricio. Sally, I want to get you into this AI discussion. And I think the angle that I find interesting when I think about AI and the oil market, because I think there might be a little bit of a connection, is that, okay, so we actually are seeing an AI boom occur, a smaller scale for sure, but in the Middle East, we are seeing OpenAI. They're building a Stargate, as they call it, facility in UAE that's going to start out at 200 megawatts and move to a gigawatt. There's a company called Humane, which is going to build a 500 megawatt facility in Saudi Arabia that's going to move to about 2 gigawatts. And the baseline there is small, so these are big numbers. But what I find interesting is Saudi Arabia currently, if you look at their power mix, a little over a third of their electricity is coming from oil here at the moment. And Aramco and some of the utilities there are already moving to produce more gas in the country to move some of that oil out of the power stack. I think that's a trend that's happening, but this means they've got more work there's more demand, so they might even have more work to do. There is a solar angle there as well, because a company called Jinko Solar actually has a big module fab that they're building in Saudi Arabia. But if they move oil out of the power stack in Saudi Arabia, that's actually going to free up more oil to export at some point once they get all of that work done. So I'm just curious if you can frame a little bit about, how that dynamic could play into the oil market over the next few years for us.
Sure. I mean, to be honest, I think you summarized it perfectly there. Even before the AI push, which there definitely is a growing AI push in the region, and Saudi Arabia is going to be a big player in this. But even before that, as you've outlined, there was this push for these countries, especially Saudi Arabia, to divert more capital spending into producing more non-associated gas to be used more domestically. I mean, they have LNG plans for later as well, but initially just to upgrade that domestic infrastructure so there is more natural gas used domestically. Because I mean, this already made a lot of sense, because that would free up a lot more of the crude oil to be exported, which tends to be a much better and much more lucrative business for them to be exporting that oil. But the good news is they really are blessed with these natural resources, and there is the natural gas reserves. So as long as they, spend more in it, there will be more natural gas production for Saudi Aramco and for the Saudi Arabia government. And also, I mean, that's part of the good news for them, is that, they are sitting on all these natural resources. But another one is, for a very long time, their motto has been just more energy, no matter where it comes from, which I think plays well into this AI story as well. Because, they are investing more in natural gas. They are investing more in solar, but it's not necessarily coming at the expense of the other sources. I mean, when you look at Saudi Aramco and when you look at their capital spending guidance for this year, it's bigger than, even though oil prices are much softer and the outlook is much much softer, their capex guidance is higher than last year. And as the macroeconomic conditions worsen and it becomes a little more difficult for them to even hold on to their base dividends, they are keeping their capex relatively high, which shows you that their motto is just more of all types of energy. They're still investing in oil. They're investing a lot more in natural gas. I think they will increase their spending in other sources as well. And as you again correctly outlined, I think the AI push is just going to accelerate it. It's not changing the direction. I think it's just going to accelerate it.
Maybe just a quick follow-up. I'm just looking at the market cap of Aramco here at the moment. Looks like it's just under 1.5 trillion US dollars, quite a bit below the very loft, the $2 trillion value that was discussed around the time of the IPO. Can you just frame for me and everyone listening how would you compare them valuation metric wise to some of the integrated peers, the Western oil majors, for instance?
Good question. And, this is something that we talked about around the time of the IPO. You're right, in that initial interview with The Economist by the Crown Prince, the $2 trillion market cap value was floated. And then for a long time, I think a lot of analysts on the street argued that it would be very difficult to get that valuation for the company, and they actually ended up doing the IPO at $1.7 trillion. And then since then, actually, Aramco did quite well, especially in 2022 when the whole energy space did really well because oil and gas prices shot up and refining margins were really good. And Saudi Aramco's market cap was actually above $2 trillion for a while. And when you look at just the valuation and PE multiples, Aramco was always, at a premium valuation, if you will, to a lot of its global peers. And you could argue that there's a very strong government backing by the Saudi government. It's one of the lowest cost producers out there. It benefits from very good geology and benefits from being responsible for the totality of the around 10 million barrels per day of total Saudi Arabia production, and it's only Saudi Aramco that produces in that country. So just being responsible for essentially 10% of global supply. But I think what we've seen in the last year or so is, some of that premium valuation fading and, that valuation moving towards perhaps some of those global peers. And I think that's partly because the difficult position that OPEC Plus as a group has found itself in, and obviously Saudi Arabia being the de facto leader in this group, generally tends to do the heavy lifting of whatever policy they take on. So, Saudi Aramco has always been a bit of a special case where, it's a listed company, but its production level is essentially being dictated by whatever policy that this group decides on. And then, they had that their production level stuck at that level. And it wasn't really bringing higher prices that perhaps the market would have thought. So they had a limited production level, and oil prices kept going down, which I think took away from that premium valuation a little bit. But it's definitely an interesting case, and definitely something to watch in the future as well.
Thank you very much for that, Salih. Just a quick reminder, we hold these calls every Wednesday at 10 a.m. Eastern. We usually run a little over a half hour. And next week, still figuring out who we're going to have on. But the following week, we're going to have Nikki Sue and Gabriela Privatera. Patricio's counterparts here in the U.S. to talk on a Utes discussion. But before we close out for today, I want to circle back over to you, Patricio. One of the topics that we've been talking a lot about lately is the difficulties that the offshore wind business has been experiencing here in the U.S. And since you cover Orsted and Iberdrola, I think you've definitely been thinking quite a bit about what that means for your space. And so specifically, you've got a note out on Orsted and some of their legal difficulties here. Could you just break us down how you're thinking about that right now? And, probably just out of the gate, what's your sense? Is this project going to restart and kind of get back going from a construction perspective?
Yeah, out of the gate, putting me on the spot. Yeah, so I think if you look at the precedent with Empire Wind, which was Equinor's project, which was halted for roughly a month back in April, they were like, that project was only 30% complete. The project that is facing the stop work order now, so Revolution Wind, is 80% complete. Most of the wind blades are already there. I recently checked the injunction, or like the lawsuit that Orsted is actually going against the Trump administration. And that lawsuit states that they stand to lose almost $7 billion if they were to exit Revolution Wind. So $7 billion is roughly 49 or 50 billion kroner. Orsted's market cap is roughly 85 at the moment. So it's a significant blow to their balance sheet and to their funding position, considering that the company is in the midst of raising 60 billion kroner in a new rights issue. So it really leaves the company hanging by a thread in that sense. They would really need to use most of the equity raise just to exit the US market. So if you take those two sort of considerations into account, I think that there must be some deal that can be negotiated. There is no, both of the states that are connecting to that power, to Revolution Wind, are blue states. So there is no clear visibility on what leverage or political leverage they could be to resume work. The lawsuit is there. We expect some sort of outcome before the 22nd of September. Because that's a key date for Orsted, given that if they don't resume work by then, they will actually phase the lease on the vessel that they need to finish installations by the end of the year. So it's quite a small time frame. But if you were to ask me, yeah, something will come to pass before the 22nd, perhaps, hopefully a restart of the projects, just given that there's so much capital at risk.
Yeah, very interesting to note. I can't remember which interview it was. So Chris Wright was speaking at the All In Summit, and he was speaking to Dan Yergin at a Council on Foreign Relations event this week. I watched both the interviews, and I think he very specifically specified that the project was not canceled, it was paused. So stay tuned. Let's see how it goes. Quick advertisement for anyone who's based in the Houston metro area. I'm going to be out there next week for my colleagues from Bloomberg NEF. Their Barrel of Tomorrow Summit takes place in Houston next Thursday. So if you're going to be at the event, definitely reach out and say hello. And if you are not registered to attend the event and you would like to, shoot me an IB or an email and get you the details on how to register. For everyone else, look forward to seeing you next Wednesday at 10 a.m. And I hope you have a great rest of your week. If you are on IB right now, I'm probably going to send you an IB here in a couple of minutes with just the survey link again, because we would love for you to participate. Take care. Cheers, everyone.
Thank you.